TraderMerlin Show for your Thursday edition. We have an exciting one today. We're going to have one longtime friend of mine come on to talk about markets. Before that, big shout out to everybody. We've got a long distance newbie here, Mezhar from Mumbai, India. Welcome to the program, my friend. For those of you who might be new, click that subscribe button. And of course, you'll be notified every time we do a live show, which as of now will be every day, Monday through Friday at 2 p.m. Pacific, unless Edison shuts down my internet again. Damn those guys. All right, let's go to the question du jour, which is this bad boy right here. It says, can you talk about gap trading? This is a question that came in a couple days ago from Tim. And of course, I could talk all about gap trading, but I figured, you know what, why not bring on a good friend of mine, Mr. Brandon Wendell, to talk about gap trading so that both of us can go back and forth on it. Joining me from sunny Florida, I'm assuming, sunny and hot Florida, there's Brandon Wendell. How you doing, Brandon?
Hey, I'm doing great, Merlin. Thanks for having me back. Actually, Lucy's here joining me, too. She jumped in my lap just a minute ago.
Hello, Lucy. Hello, Lucy.
She's waving. Look, wave.
It's funny how you'll bring their animals on. When Tilly does it, she's got her cat walks all over the keyboard, and it's in the middle of the shot and everything. I'm like, you can put the cat out, but you know what? Let's bring our animals on. I would show you mine, but he's over here passed out. You'll probably hear him snoring in the background here shortly.
Nice.
All right,
Lucy's ran outside. I guess she saw a squirrel, so she's gone.
Oh, don't say that word too loud. My dog will literally bolt and run for the doors. Tell me what's going on in your world, man. It's been a while since you and I have chatted.
Yeah.
Anything new going on in your world?
Well, I brought the bow tie back because everyone was asking
Noticed
what the bow tie was, so I decided to, I went back with that again. No, it's, just been the same old. I've been working very busy for the Wealth Builders HQ, doing the E-mini think tank and teaching and trading. We did a bunch of trades live this morning in the futures markets. That's usually what I focus on there, but obviously a lot of the strategies can be used everywhere. So just been keeping busy with that. And, staying happily married, still newlywed for the most part. Coming up on 2.5 years now, so.
You've only got another 60 left.
Yeah, exactly. I should live so long.
You're right there. Look, you and I have known each other for a long time, obviously going back to the trading floor days in Irvine, and this is a topic that is nothing new, right? Gaps are just an element of trading which we have to deal with. And going back to Tim's question about can we cover gaps, he didn't give me any specifics on what he wanted covered, so maybe you could start it off talking about gap trading, maybe what it means to you, and kind of what are you looking for?
Sure. When it comes to gaps, I definitely love trading them when there's the opportunity to do so. And it's interesting because I'm mostly a futures trader, and you probably think, well, wait a minute, aren't futures traded nearly 24 hours a day? What kind of gap could you possibly trade? And in reality, it's actually an artificial gap that you have to create by manipulating the chart. Mm-hmm. Now, the techniques will work the same, as I mentioned, by using either the futures, or if you do the same thing on stocks. And let me just go ahead and share my desktop with you here, and I've got a couple notes. There we go, share screen, and start sharing. Cool. I think that worked. So what you see, it should be showing the E-mini think tank, and we have what is called an inside gap. And for instance, an inside gap is when you open up, so you can see, if I zoom in a little more here, on that first picture, you can see we've got the blue, which is the Tuesday charting, and then it gaps up on Wednesday in the purple, but you can see we didn't open up out above the prior day's high or below the prior day's low. So if you gap within the prior day's price action, that's called an inside gap. And usually with an inside gap, they tend to fill very quickly. Mm-hmm. So I have the example just below that where you have the gap down, but again, it's inside of the prior day's price action. Now, if you're doing this with futures, you actually have to manipulate your charts. In TradeStation, they use what's called .D charting for the equity indices. You can see at the bottom. If you're on Thinkorswim, which I am, I'll go over there right now. Here's the ES, and what I have to do is simply change my chart a little bit here. Go into futures, turn off the extended trading hours, and now we see gaps. So
Magic. And everyone says they don't gap, Brandon, but here they're gapping.
Exactly. Well, again, you got to know what you're looking for, right? So you got to manipulate it a little bit. Let me go ahead and clear my chart off. But yeah, we actually can see gaps on futures if you know what to look for and how to look for it.
And for those who don't know, all he's done is said, look, even though these things during the days are for the most part trading 24 hours, we want to remove those parts when the equity market is closed. So what he's showing now is going to be the S&P 500 from 9:30 to 4 p.m. Eastern Standard Time. Everything else, even though it trades, is not displayed, and therefore we get to see the gaps.
Exactly. All I've done is erased everything outside of what they call regular trading hours, or the old pit hours, if you will. And by doing that, we can see gaps. So typically with the inside gap, they fill very quickly, usually within the first 15 to 45 minutes of the day. For instance, here you can see going from the 23rd to the 24th, there's an inside gap. And what happened was we had prices, there's Tuesday's low, Tuesday's high, and on Wednesday morning, the open was, let's see here, get my arrow, there it is, at the bottom of that candle. That's the open on that green candle. And you can see that open is within the prior day's price action. So you would expect the prices to close that gap at some point within the day. Sure enough, a little bit later, it did, as you can see.
Right.
So that's the inside.
And keep right there. I go back to the chart. I think it's kind of interesting. One thing that may help is, can you put a vertical line on the last bar of the day?
Sure.
I think that just helps people, because what you got to know is this is a 15-minute time frame. So everything you're looking at here is a 15-minute candle. So all those candles to the left of that line that Brandon just drew in are from the previous day. Actually, they're from the previous couple of days, to be honest. So just so you know, when he's talking about that gap, he said an inside gap. The one where he drew that little arrow on, it opened within the range of that previous day, which he has mapped out there with those blue lines. So just putting a little bit of context here so you guys can see, because I know some people, Brandon, might have looked that way. Wait a minute. It didn't gap inside that previous candle. No, it's the range of the previous day.
Exactly, yeah, and that's what I have in my sorry, there it is. My explanation is today's open is above the prior day's low and below the prior day's high. So you're opening within the prior day's price action, not the prior day's candle, but the price action between the high and the low of the previous day. So typically those do try to close the gap. And a question came up, how do you know if it'll close the gap up or down? It just depends on which way it gaps. In the example I just showed you, we had gapped up, so you would expect it to close the gap by moving back down. But first, it needs to find a good supply zone. Mm-hmm. Well, we had one that was actually not qualified right here because I've got very specific rules on how I find my zones. This one wouldn't have qualified because the high was above the basing candles for the leg out. So the one that would have qualified was right here. And you can see that during the day, it came close to it, didn't quite hit, but that's where the prices ended up reversing and closing the gap. So the gap is considered to be closed when prices reach the prior day's close. So that green candle with the vertical line, that was the prior day's closing candle. Mm-hmm. The official closing price was at the top of the body of that candle, and you can see the gap is now closed once we've gone back to that point. So that's an inside.
That's an inside, right? And for less, I always like to add my 2 cents to this one. How do you know if it will close the gap up or down? You don't know. Nothing in this world, and I'm going to go on camera for this one, you'll never know 100% that anything is going to happen, right? It's about saying it's a probability piece. And there's a characteristic, there's a nature to the buyers and sellers that created that gap. For whatever reason, obviously sentiment was positive going into the open on that next day for the S&P. That said, there's things to look out for that may give us clues that it's going to reverse and close that gap or continue and potentially make new highs. So I think that's the challenge, Brandon, because a lot of people feel like it's just cut and dry, like, oh, it's an inside gap, therefore it has to do this. Not necessarily.
No. In technical analysis, everything always happens except when it doesn't. So there's nothing that's 100% guaranteed. There's another thing when it comes to these equity markets. I mentioned there are 4 U.S. equity indices that we follow: the NASDAQ, the Dow, the Russell, and the S&P. All 4 of them should be doing the same type of gap. If they're not, then there's a lower probability of the gap play working out. So you want all 4 of those to be doing the same type of gap when you're reading them as well. So I need all of them to be doing an inside gap. The opposite gap is called an outside gap. So I'll go ahead and share this with you again. And there we go. So let me just skip down. That's inside. Outside gap. There we go. Mm-hmm. And it's just the opposite, where you gap outside of the prior day's price action. So you either open up with your price being above the prior day's high, or you open up below the prior day's low. So you have what is called an outside gap. Outside gaps don't usually close very quickly. As a matter of fact, they may stay open the entire trading day. Instead, what often will happen is the prior day's high will act as a bouncing point for a long opportunity during the following day. Or if you were to gap down below the prior day's low, typically the prior day's low will act as a bouncing point as well. And that's actually the gap that occurred today. I'll go ahead and clear my chart here and go back to current price. So what initially happened with the open, I'll just go to today's open right there. You can see we gapped down, and once again, I'll bring in the lines to mark. This is the close from yesterday. and there's the open from yesterday. So that's all yesterday's price action. And we have the prior day's low right here and the prior day's high. Oops, it's already set right there. So what I normally do is I look to see, okay, what candle gave us the low from the prior day? We gap below it. That's going to act as a little bouncing point for price the first time it gets up there. And in fact, I didn't trade this one. I traded the NASDAQ, and we made a little bit of money on that. But you can see we went right up to the low from the prior day and pushed down. Mm-hmm. Once again, it's important that all four equity markets are doing that. If you've got the NASDAQ, the Dow, and the S&P doing inside gaps while the Russell's doing an outside gap, all bets are off. Right. The highest probability occurs when all the markets are doing the exact same type of gap. So again, I mentioned that I did this on the NQ today. If we go out, let me see if I change my chart here. I'll just show you NQM21. That did not take what happened there. Come on. All right, got to pay the bills. There we are. So we take a look at the NQ for today, and actually, there it was. Still got some lines left over here, but you can take a look at, there's the low. And this one overshot a little bit, but initially, the very first candle of the day went right up to the prior day's low and turned around, started going down. So I was able to make some money on that initial move to the downside. And it was a pretty good move. I think it was good for, I don't know, about $500-$600, maybe a little bit more. Before it started turning around, we ended up getting stopped out on the way back up. But this works on anything that gaps. And remember, I had to kind of artificially create these gaps when it comes to the futures. But if you were to look at a stock, say, for instance, Apple, and now when I look at this, I must take off the pre-market activity. So right there where it says extended hours, I can only look at regular trading hours. But we can do the exact same analysis that we were looking for in the futures on the stocks. Now, of course, I didn't find any gaps, but there it is. Now we finally got some. So when you have gaps, you can look to see, okay, where are we opening up in relationship to the prior day's high or low? Get rid of this in volume 2. Yeah, I'll leave that there for now. Anyway, but you can look to see, is it an inside or is it an outside gap? And often it will bounce off those areas. Not always. Mm-hmm. Okay, again, you can see that some of these are working, some of them are not. There was an outside gap down right here. You would have expected this to work as a bouncing point, and unfortunately, it ended up closing the gap completely. So it's not foolproof, but the probabilities are high that if it's an outside gap, it will stay open. If it's an inside gap, it will close.
Yeah, and with those, there's a belief in the industry, and I'm definitely one of those that believes that there's this magnetism towards price when we get gaps that it wants to fill. Now, that said, my mentor back in 1998, he was saying, look, there's gaps that will never fill. And even, it's funny because at the time we were talking about Amazon, actually it was a little bit later, but it was, there was some company, and I can't remember. But he was like, look, there's some gaps in that stock that will probably never fill, because it just kept on going. And unless they go bankrupt, they're not going to get to those $2 gaps now that's trading at $1,000. However, a lot of gaps do fill. And part of my trading plan, at least from the swing trading perspective, is looking for those gaps to fill and planning for it. Now, as Brandon just showed on one of those last charts there, it was interesting because you had an outside gap that you're thinking, okay, it's going to fill. It's going to come back and close that gap. Well, had you immediately bought long on that security, you would have lost a bunch of money and most likely been stopped out because it kept falling. The point I'm trying to make here is you have to make sure that the stock is doing what you want it to do. So, for example, if it was a gap down outside gap and started to continue to fall, probably not the time to buy it, right? Because it's just going to continue down until it doesn't. And then once it turned around, you saw it came all the way back and closed that gap. But don't buy or sell or short a security just because you think that gap is going to fill. You have to let it prove that it's going to at least be moving in that direction.
Sure. Well, there's some things you can do to increase your odds when it comes to the stocks as well. Remember, I was talking about with the futures, you want to make sure that all the markets are doing the same sort of cut-off gap for higher probability. When it comes to the stock market, the individual securities tend to follow the indexes themselves. You get a lot of influence from the indexes. You get a lot of influence from the sectors and the industries for the individual stocks. So if you want to increase your odds for figuring out which way the markets are going to gap and which ones are going to fill, you got to understand how futures work in comparison to the underlying index. And there's something called fair value. Now, this gets a little complicated, but it's not really too complicated once you figure it all out. What can happen is the futures are basically cheaper ways of trading the index. You can go out, let's say for instance the NASDAQ. You could trade the NASDAQ 100 by going out and buying every single stock in the NASDAQ 100 in their weighted proportions. Or you can go out and buy the NASDAQ futures, which is basically owning the NASDAQ 100, but you get to trade it on leverage or with leverage using a small margin deposit. So the theory behind that is if you don't change the price of the futures, nobody would ever buy the stocks because it's cheaper to buy the futures. So what we have attached to the futures is called a fair value. And the fair value actually adjusts the price of the futures upwards in order to compensate for people not buying the stocks. That's kind of a longer explanation. It's necessary, but every futures contract has a fair value attached to it. Now, the one thing you don't get when you are trading futures, but you do with the stock, are dividends. So dividends are subtracted from that fair value. So if you were to compare if you were to compare an index future against the index, you'll see they're not priced the same. And the reason why is called fair value. So if you can see where the index is trading in relationship to the futures first thing in the morning, within the first 5 minutes of the open, what will typically happen, if you think about it, the indexes and the stock market are officially closed prior to 9:30. But futures are trading in relation to whatever's going on in the world. So the instant the market opens up, the stocks now and the index has to catch up to where the futures are. And they're going to be separated only by that fair value in the end. So it's probably easier if I kind of show you visually what happens and how to use this. Because
it's funny because it's funny you say that because there's actually people who will sit there and literally try to arbitrage that fair value and try to capitalize on that tiny little difference there. And when you have algorithms and you're trading big enough share size, it certainly can be a viable way, but for me, it was just too much to worry about.
No, it's for us to do it, it's almost impossible. It's very difficult to do it. That's why I don't bother. But there are program traders out there. I mean, it's a big business. But when I was back in 2008, I was fortunate to have dinner with the CEO of the New York Stock Exchange. At the time, it's Duncan Neurauer. I can't remember who it is now. But they said, at the time he said, program trading, the sheer volume that they were doing there, basically a program trader sets up a computer, they lease space near the New York Stock Exchange in the upstairs or something, I don't know. And they would basically trade this arbitrage opportunity between the futures and the stocks that make up the index if they went out of whack, and they'd bring it back in line to fair value. That, he said at the time, in 2008, that was almost 80% of the volume of the New York Stock Exchange.
Wow.
Was program trading. It was huge. Yeah, it blew my mind. I couldn't believe it. I don't know what it is now. I imagine it's still pretty large, but you can't compete with that. I mean, first of all, the bandwidth. Their servers, their trading computers are at the floor.
Yeah, they're co-located right next to them. Yeah.
Yeah, you're not going to be able to get the speed that you need to jump in front of them. Secondly, you got all the algo traders and everything else going after it. But let me just go ahead and share with you real quick. I'll do this. And there's a website you can go to, and this will help you out if you're trying to figure out which stocks you likely will want to trade. Let me see here. I think we'll do this. Index ARB explains a little bit more about that fair value. It's a free website I go to, and you can see it shows fair value premium for March 25th, and it'll be updated every evening. This was updated last night at almost 10 p.m. Eastern. So today, the fair value for the S&P was 1085, negative 1085. That means whatever the index was trading at, the futures should be roughly 11 points below that. That's the fair value. And you can go over here to where it says fair value decomposition and see it's the interest that can be earned on the futures contract, or the money not being spent by buying all the stocks minus dividends. So I don't want to go too much into that, but I just want to show you, let's see, the easiest way to show, probably two charts next to each other. I'll do it this way. You see. I'm trying to think of the easiest way to do this. Yeah, we can do that. So if I do index, and nope, let's see, SPX.
Say I never heard of that one. The Ayamundi? Oh.
I don't know what that was. And then ESM 2021. That's the futures. There they are. So if I take this down to, say, a 5-minute chart, and they're both on 5 minutes, I believe. Yes, they are. Perfect. So, when we go back to this morning, you can see 9:30 a.m. is right here. And, oops, that's not 5 minutes. Let's go 5 minute. There we are. Nope, 5. That's the index. And we go back to 9:30, and there's a gap there. Why is there a gap? Well, again, the index was closed until 9:30. So this is March 24th, 1600. Well, if you go back March 24th, 1600, for the futures, that was ages ago.
Mm-hmm. Yeah.
But for the index, it was the last candle. Why? Because the index doesn't participate in all this overnight stuff. So what happened? Put it easily, briefly here, you can see at 7 a.m. this morning, the equity futures dropped. So what had to happen was when the futures were open, or sorry, the stock market was opening at 9:30 in the morning, the last trade here on the futures was at about 38.64. Based on the fair value, right? So we've got the index, or the futures, I'll just say ESM21 was at 38.64. Is that what it was? Yeah, 38.64. Yep. The fair value was, we'll just say 11. I'll make it easy on myself. Is negative 11. That means that the SPX, or the index at the open, should be trading at 38.75.
Yep.
Right? Because you just add that. So the problem was we closed at 38.88. So when the market opened, it had to go down, and you see, where did it go down to? About 38.70.
Yep.
Now, why did it go beyond 38.75? Well, look at the futures. They were also moving down a little bit. So by the close of this candle, let's see if it was actually there. 38.60, and here.
Yeah, but about 10 points.
There it is. That's your separation. How much were they separated by? The fair value.
Right.
So how do we use that? Well, if we know, for instance, in this case, the S&P just before the open needs to gap down and move down to catch up with the futures. If you have stocks that are gapping up, what do you think they're likely to do?
Head to the south side.
Exactly. So if the market itself must drop to meet up with fair value, stocks that gapped up are likely to be dragged down only until the index is at fair value, which can take less than 5 minutes. So that gives you a quick drop, a short opportunity on those stocks that are gapping up to be able to short them and meet up with the index. So in order to find those, you can do this on programs sometimes. Also, if you go to NASDAQ.com, very easy. Certain programs, I know TradeStation used to have big gaps up, big gaps down. Yep. You can do scans and stuff like that. But right here, market activity, pre-market quotes on NASDAQ.com, it'll give you the list of the stocks that are gapping up the most. And NASDAQ stocks tend to do this the best.
Yeah. So
see, Tesla, WiseKey, Canaan. So a lot of these stocks were gapping up. Apple, I don't want to see, not penny stocks, not small price stocks, but decent stocks. Even American Airlines, AAL was gap. I don't know what it was now, but that was by share volume. Sorry, most increase before the market opened. There we go. And you got CERT, CERT. Let's take a look and see what happened at the open with that. So I'll maximize this chart, CERT, and you can see right there, it gapped up, opened up at 28.21. The first candle, it moved up a little bit, but it also started to go down, and it closed some of the gap. Now, the best way this is going to work is if you got some sort of a supply zone that you're gapping up into, and if you could find stocks, usually 15 to 20 minutes before the market's opening, that are on this list that look like they're going to gap into areas of supply, they should get pulled down by the market, and you got an easy maybe 5-10 minute trade for the first part of the morning. Now, if they're inside gap, they may continue to go down and close the gap 100%. If they're an outside gap, now you've got two trades. So let's see, MGNX.
And I like what you just said there. When you see the gaps, again, it's one thing to have a gap. It's another to start to quantify it and put it in an area where you think it's going to have a higher probability of moving or turning. So, for example, in that situation, you said if it's gapping up into supply. Now, all of a sudden, you have a little element that you can use to put in your favor, right? We'll call that an odds enhancer if you want, whatever you want to call it. But it's now a supporting piece of information that says it's most likely going to come back down. Same thing if it gaps into an area of demand. It's like, okay, I've evaluated this area, feeling pretty good that it's going to stop or bounce here. Now, all of a sudden, we can use that in conjunction with the gap phenomenon and make ourselves a higher probability trade setup.
Yeah, exactly. And like I was saying, now this is not the best example, the macrogenetics. However, it was an outside gap. Okay, remember I just talked about the outside inside
Yep.
gap. So if I go share this again real quick, if we look and see that this was an outside gap. Okay, now this is not a great stock because it's very light volume. I also typically avoid these anyway, but it's what I happen to show here. So we've got, let's see, vertical. Oops, there it is. And let me see. Oh, hang on a second.
And I love that you said that, guys. If you see this chart, you see those weird just dashes, and it doesn't look like a very continuity type of chart. This stock trades it's under 1 million shares per day. So I'm not going to say it's incredibly thinly traded, but just when you see a picture like that, you automatically got to know that trading whatever this company is risky, because that is a sign of you have all sorts of intraday gaps on this on a 5-minute basis. That means a widespread, relatively thinly traded. Other than using it as an example on gaps here, I wouldn't even entertain trading this stock.
Right. Now, I was just using an example. I would not trade this either. But what happens is if it's an outside gap, it should balance at the prior day's high. And you can see we came down into this area and bounced a little bit as well. So this is not the example I'd really want to look for. I want to find something that's a little bit heavier traded. Again, I don't know many of these stocks. And sometimes you have the opportunity, some days you don't.
Go to the most, you can share by on the top, you can sort by most active volume.
Yeah. And the only ones we had was HWCC. I could try that. Oops. There's even here, this wasn't good. It's most volume for today.
Look at that chart. Oh God, that's awful.
No.
But no, I mean, hey, look, I'm not picking on it. I think it's actually great. It's a great example because you're looking for opportunities. But then again, that chart right there, there's no way. The Houston Wire and Cable trades on average 200,000 shares a day. And that's due to a big spike that happened today. It's got the mother of shooting stars if you look at this thing on a daily. But this is a...
No, but you get the idea. I mean, if I can find stocks that are more heavily traded, again, if you've got certain software that can search for those things where you've got securities that are gapping up and they're moving into areas of supply and they have decent volume and they have normal charts you can actually trade, then that's your opportunity. You can go ahead and short those as the market is pulling back down to close to its fair value, and vice versa. If you're gapping up because the market is down, but the futures were up first thing in the morning, you find stocks that were gapping down, and you can potentially buy them for them to go up and close their gap. Yep. So, you've got plenty of opportunities out there, but you do have to be a little quick in order to be able to figure out, okay, what do I want to trade and how can I get in? And of course, the trade usually only lasts a few minutes now. It used to last 15 to 20 minutes. But because of the computers and the high frequency trading, it's gone much, much faster when it comes to the this is really taking advantage of an arbitrage.
Yep, absolutely. It's funny. Patrick says, "Gosh, really, people really moved to New York to set up exchange next to the computers to get 8 points." Yeah, you may think that that's silly, but what's happening here, this is literally a trade that's going to take them seconds to execute. And by co-locating and being literally nanoseconds in front of me or retail traders' orders, they do have that competitive advantage. And if you're trading 1,000 lots at a time and all of a sudden you capture just a half a tick, you're rich. It's just a scalping methodology all over again. So there are people that do it, and it's purely automated. They have to pay huge money to co-locate their servers next to NYSE or NASDAQ servers and just let it run. They've got the goose that lays a golden egg, but they're paying for it.
Sure.
Rob says, do you use open interest close to the strike price as a tool in conjunction with stock gaps to help determine if the gap will fill?
Well, as far as open interest, you're talking about on the futures to see where the market's
options.
Oh, no, I don't bother to look at all that. No, I mean, this happens so quickly in the morning that I don't even bother. I'm just looking at price action. So I usually look at the futures and see, okay, if all four are doing inside gaps, high probability we're going to close. Next, where are we going to turn around to close the gap? So I look on I do several things. First, and I'll share again. Let's see, where is he here? Oops.
Sharing is caring.
Start sharing. There we go. So if I go into my trading platform, one of the charts that I always keep open is this one.
Yeah, I've got a similar one. Yours is a little busier than mine, but I definitely have a similar layout.
Yeah. Well, the one that I'm going to look for, actually, this is running really slow. I don't know what happened there. There it goes. Come on. And it's called Follow the Leader. I actually just recently did a video on this on my YouTube channel. And for instance, this is zeroed out at 9:30 this morning. You can see that's the Russell. There's the Dow. There's the S&P in blue and the NASDAQ in purple. And what it does is it lets me know which market is leading and which one is lagging. And I trade the leader typically. So if we're moving to the upside, for instance, this morning, you can see the Russell was the leader to the upside. It was the strongest and fastest mover. If I was looking to short, you wanted to trade the NASDAQ, that was the weakest market or the leader to the downside. So if I was looking for a gap closure or a bounce, so for instance, this morning I was looking for the gap to close and then turn to the downside because it was an outside gap, but the low and the close were at the low yesterday. They were both the same. So the weakest index was the NASDAQ, and that's why I chose the NASDAQ for the short opportunity. So going into, there it is now on the NASDAQ, and taking out the overnight trading activity. I don't really need to do that. I can still do it with the trading activity there. I just draw my lines the way I want them. And looking at this, you can see for the first, it was actually 5 minutes. It's a very quick transaction this morning. But the very first 5 minutes of the day, I already had planned to short the NASDAQ because that was the leader to the downside. And you can see right here, this was an outside gap. We opened up with a gap down. There's the prior day's low. Pull that back a little bit so you can see. And that candle, that area was going to act as a bouncing point. So what happened was we came up into that area, I was able to short, and you can see we started dropping down for a push to the downside. And that was the play. Unfortunately, it turned around on us, but I got out at break even or a couple dollars profit because I moved my stop down before it turned around. Mm-hmm. And the other problem we had was there was actually a couple demand zones nearby. Normally, I wouldn't do that if there was any sort of demand nearby because I want to be able to make it run or let it run and make a bigger profit on that. But on prior days, I mean, this could work out beautifully, especially like trading the NASDAQ. This was another one. What are we looking at here? The 23rd to the 24th, you had a gap up. There's the open of the day. There's the prior day's close. And you can see it was an inside gap. We were inside of the prior day's price action. So we easily closed it. If this were the weakest market, that'd be the one I'd want to short because it's going to close the gap. And in this case, it just kept running. So you can do this on any given day. If you have certain gaps, there's another one, gap up. Now, this didn't really have a good supply zone, unfortunately, but if it had a supply zone, it moved from about 115 all the way down to, about 1080. So would you move about 35 points?
Plenty. Yeah, that's pretty nice.
Yeah, 35 points first thing in the morning. I mean, come on. So, yeah, that's what I'm looking for. Just some quick, easy moves in the markets to get those gap plays.
Lifesong is sending a good comment here. Lifesong in chat says, how do you trade gap and go? And for those that aren't familiar with it, you have inside gaps, outside gaps. A gap and go is where something, let's say, for example, it gaps up and then just keeps on running. And again, there is obviously an expectation that prices may fill that gap, but there's no guarantee that that's ever going to happen. And you may never see that gap fill. Do you have specific rules for those kind of gap and go where they just keep on running?
Well, that would be an outside gap predominantly. When you have a gap and go, it's normally an outside gap. And 9 times out of 10, it pulls back to the prior day's high or low before it goes. So why would I want to get in right away if I don't know it's going to gap and go when I can wait and usually get a better price entry?
Right.
So for instance, if it's a gap up and I'm expecting the gap and go because there's nothing above and they're all outside gaps, like I said, the majority of the time, maybe not 9, maybe 8 out of 10 times, it'll pull back first to the prior day's high. That gets you a better entry, and then it goes with you on board. So that's how I play the gap and go. And if it doesn't come back, okay, so I missed an opportunity.
Right.
That's the thing. You're going to miss opportunities in the markets. There are plenty that you can take advantage of anyway.
Yeah, and I think with regards to gap and goes or professional gaps, amateur gaps, novice gaps, right, whatever the gap style it is, for me, bottom line is there needs to be rules in place. So, if you are looking for a gap and go, a trade that just gaps up and keeps on running, great. What are your rules for it? I have no problem with anybody's strategy, it doesn't matter what it is, as long as you can tell me what your rules are for trading that setup. So if you tell me that, engulfing pattern is my favorite pattern on earth, awesome. How are you trading it? What are your rules? Inside gaps, that's my thing. Okay, great. How are you trading it? So, you can't, I don't think any of us could look down on anybody else's style and say, well, you suck, you're a bad trader because you do this. No. As long as you got rules in place and you can prove that it's working for you, I could care less what you're doing. As long as the end result is you're making money, go for it and keep doing it.
Yeah, I got to agree with you on that. I mean, you just got to have a set of rules, and the main thing is risk management. And if you're not protecting your money, you're probably not going to have it long term. So, there's not one strategy that fits everybody. There's not one strategy that's the golden egg, the golden, the trick to be successful in the markets. It's, as you said, there are many different strategies. As long as you have rules around them and you follow those rules on a regular basis, if it's working for you, then that's what you're supposed to do.
Yeah, absolutely. Rob, good question. He says, how does he short? Okay, he says, I don't have an account that I can short stock. So my guess is, Rob, you're probably in a retirement account or a cash account like a 401k or an IRA or something like that. That's a slight problem. For Brandon to short, it's simple. He's trading futures. You just hit the sell button. I mean, that's easy.
Yeah, with the futures, you're not actually shorting. You're selling a futures contract, so you don't have to worry about it. And with retirement accounts, if you have a self-directed IRA, you can open up a futures IRA, and you can sell in the markets. So, other than that, trying to scalp an options contract by buying a put, it's probably not going to work out for you, because by the time you get the orders filled, the prices are going to move too much. So don't try to do that.
Yeah.
You can day trade options. Don't get me wrong. It's just that with the gap play, it's going to be too quick.
Yeah, and if you don't have, it says here, I don't have an account that I can short stocks. Well, one of the things you can do, Rob, is you could buy something that is short. For example, instead of, let's say you wanted to go short SPY, but your account won't let you short SPY, which is the ETF for futures, or for the S&P 500, you could buy SH, and SH is the inverse of the SPY. It's built in. So that's one way around it, is to use inverse ETFs. If you felt something was going to be going down, you could simply buy a short ETF. If you're not allowed to short stocks, then you can't hit that sell short button. If you have a futures account, there isn't any shorting rules. There's no uptick rule. There's no shorting rules. If you want to sell it, you simply sell it, and you're betting it's going to be going down. That's the way the futures work.
Yeah. Let's see. Richard had another question about all the gaps in the program, searching for them. Would it be easier to learn price action for each market? Would it be a better approach? What we're talking about with the program trading is they're just simply looking to see, is the S&P index in line with the futures, or are they out of whack for the fair value? And, in order to be able to trade those individual stocks, they're not necessarily trading the ones that are gapping. What they're doing is they're buying and selling the stocks that make up the index to try to drive the index back in line with the futures. So there's still individual opportunities to trade that as a strategy. And, if you wanted to learn price action and read the individual, pick a security you like to trade on a regular basis, then do that by all means. This is just an additional opportunity that is out there that you can start to formulate a plan around if you decide to do it. And if you don't decide to do it, that's fine too.
Yeah, it's not that and I like the question. I'll read it because I know we have people listen to the podcast. Richard says, if all these gaps have programs searching for them, would it not be easier to just learn price action for each market? Wouldn't that be a better way to approach trading? I think that goes back to my previous comment. Yes, there's programs out there searching for everything in the markets. So you're talking supply and demand. I'm sure there's programs just searching for supply and demand. You're talking specific trading formations of haramis and engulfings and shooting stars and pennants and flags and RSI overbought, stochastics over. There's programs searching for every single one of those, plus stuff you've never even heard of. Does that mean we shouldn't be using those tactics? No. And again, and Richard, since you brought it up, if you're doing something with regards to price action, which I personally believe is the way to go, then great, that's what's working for you. But, maybe you experiment a little bit, and maybe you're looking for a scan or a filter to find bigger gap ups. So you have a much bigger opportunity there potentially with a large gap up. Nothing wrong with that, right? Experiment and try new things. I think one of the problems that we have as traders, I'm definitely guilty of this over the years, is you get stuck in a groove and you become complacent and you say, well, I've done this for so long, it's just the way that it is. One of the great things about working with so many amazing traders for the past 20 years is I've learned all kinds of cool little things. I went, I've never done that before. Let me try it out. And all of a sudden I might do something and go, well, shit, I thought that wasn't going to work. And now all of a sudden it's working great. I have to experiment a little bit. I'm not going to switch my style 100% midstream, but I'm going to take a little portion of capital and maybe try a different strategy here. And if I can prove that works, that may become my main tactic. But don't ever rule anything out because you think some computer's better than you. Odds are I think we can probably do better than computers. I hate to say that, but I think we can. All right, let's see. Lifesong says, Brandon, do you also consider Globex gaps the same way that you consider regular trading hour gaps?
I'm not sure what you mean by Globex traps. I mean
no, not traps, but gaps. So like gaps. An overnight gap in the Globex.
Well, I mean, that's all it is.
Yeah.
The gap itself is taking the Globex trading out and only looking at the regular trading price action. So, I mean, the only type of gap you would actually get in the Globex would be from Friday until Sunday afternoon when the markets reopen. But yes, I would treat that the same way.
Yep.
If you're talking about a gap coming from the 4:15 shutdown until 6 p.m. when things reopen, then no, I don't bother to trade that because that's just a clerical type of move, and usually that's not going to have any kind of an activity for it.
Sure. And Lifesong, I think that part of that also, and if I understand, you're talking about during the trading day. If you have intraday gaps, so let's say it's 11 o'clock in the afternoon here in California, and all of a sudden I'm trading something and it has a big gap during the regular market, that tells you something. That tells you you're probably trading something that's illiquid. And right away, that would make me not want to trade it. An intraday gap is a completely risky thing. You shouldn't have it because you want something that's liquid. It's going to give you continuity of price, and those gaps should be avoided. So if you're trading something that gaps intraday, just move on. I'm willing to bet you if you look at the volume on a daily time frame, it's going to be under a couple 100,000. So just leave it alone.
Yeah, anytime you see dashed lines on the charts or anytime you see the intraday gaps, it's definitely a flag that it's not something you want to be trading.
Yeah. Especially like today, it was great that Brandon brought up those couple of charts because you saw some what I'll call one-off examples where you have a chart that looks like crap and all of a sudden one day it looks great and is all over the place. It's probably going to revert right back to where it was and look like crap in the next couple of days.
Yeah, pretty much.
All right. Well, what's on your docket? I know you've got the think tank and you're doing all kinds of other stuff. What's your schedule looking like? If someone wanted to learn from you, where would they go?
Well, definitely, you can hit me up on Twitter as well. I'm at TraderBDub, and I'd love to have you guys join me in the E-mini Think Tank. With the E-mini Think Tank, I actually have recordings of several different strategies, including the gaps and traps, because I do things with what we call Globex traps as well as with the gaps on the futures. So if you're interested in learning more about that, if you join the E-mini Think Tank, you can actually get 2 weeks free trial. What we do is we let you enroll and you put down your credit card information, but nothing's charged for the first 2 weeks. So it gives you a chance to kind of feel it out, see if it's right for you. And that way you don't have to worry about trying to get a refund. If you decide you like it, you just let it go and you stay in the program. It's billed quarterly that way. If you want to just try a month-to-month situation, that's more than welcome to do that. There is no 2 week free trial for the month-to-month. It's just on the quarterly subscription. So you can go ahead and, like I said, if you just hit me up on the Twitter, is probably the easiest way to do that. I can give you the link to be able to go and join that program. And inside of that, like I said, there's a video I did, a bonus session, because I do live bonus sessions in addition to the live trading sessions we do. And I taught that how to do the traps, how to do the gaps in much more detail. And there's documentation that goes along with it to kind of structure the strategy. And, just like Merlin was saying, we have rules around all the different strategies that we use to make sure we're doing them correctly and consistently. And that's one of the things I like to be able to share with my students, the stuff that I've learned. Merlin and I have known each other for over 20 years, believe it or not. And, over that time, we've tried a lot of different things, and some have stuck, some have worked, some have not. But all that what we try to strive for is being consistent and having rule-based strategies that will work in whatever markets we're looking at dealing with.
Yes. Sorry, I was just reading the latest comment. Rob's busting my chops over there on VAH. No worries. We'll get to that. Awesome. So I had Brandon's Twitter handle up there underneath his picture. The guy sees it says Twitter. It's at TraderBDub. So you can check him out. And pretty much every day, guys, he's posting charts and offering some analysis about specific zones and levels, which as a learning tool I think is great as well. But it might be something to add into your routine and see kind of what he's looking at and his perspective on it. So, hey, Brandon, thank you so much for coming on today. I do appreciate it. I know it's hot and sunny down there in Florida, so we'll let you get back to your air conditioning and hopefully go check out some sunset over there.
Yeah, well, like I said, it is a real bow tie, so
I appreciate the talent it takes to tie one of those. I actually did it twice for weddings I was in. I was like, man, that is the talent. So,
well, not too bad. You just got to get used to it.
It's harder than a regular conventional tie. Conventional ties are easy.
Yeah, I guess it is. It's just a different tie. That's all.
Nice. Well, I look forward to the next one. Yes, Thomasina says, is he on Thinkorswim? Yes. Brandon, if he's like any of us, he's using multiple platforms, but Thinkorswim is one of yours, right?
Yeah, Thinkorswim is one. I was also using NinjaTrader as well.
Cool. All right, Melvin. Well, hey, thank you so much for coming on. I'll look forward to our next month encounter. Have a great day, buddy.
All right, thanks. You too.
I'll talk to you later. Guys, that was Brandon Wendell. You can find him at TraderBdub on Twitter. He'll get you all the info you need to know, and he's also got a lot of great content out there. It's funny. It's really weird when you put it in perspective. I've known him for 20 plus years. It's actually over 20 years. And, we've both been in situations where we've had our teeth kicked in by the market. And those are some of the things that we've commiserated with over the years. And again, him sharing some of his losses and successes and me doing the same thing for him has made both of us better traders over the years. And it all just comes down to, having rules in place, having structure in place. And I think what's nice about what Brandon was showing today was he had specific rules for his gaps. Now, of course, we didn't look at his whole trading world, and I didn't look at mine either. But with regards to gaps, you got a little glimpse into what his strategies and tactics are, and hopefully that was helpful to you guys. All right, since Rob is busting my chops and says VIH on a 1-minute chart has gaps during the day, correct. Am I trading? And I'm glad you brought that up. And by the way, I wanted to show you this one too. It's funny, Brandon has a price percentage chart. Guys, I do the same thing. This is the S&P 500, the Dow, the NASDAQ, and the Russell ETFs, and I can track them from any point. So you can see very clearly here today, Russell from the open, one of the strongest one today. And so if you're looking for markets that are moving or securities that are moving, obviously my best play today was to be looking for things in the Russell 2000 smaller cap stocks. And I have watch lists for that as well. You can see the NASDAQ was the weakest of the bunch, but it's great for me to look at not only on a let's say a 15-minute time frame, but if I were to go and switch and make this a daily time frame, I love going and seeing how it's performing for days or months or weeks. So for example, I will do a price percentage chart right here. Here is your results from the 1st of March to see how the markets have been performing. And right now, the Dow is the big dog, right? And I think we talked a little bit about that, about how some of the money's coming back into the big stocks, the big names. You see the weakest performers, the Russell 2000, followed very closely by the NASDAQ, both down about 4%. So this is a great tool, whether you're a longer-term investor or an intraday trader, is to look for price percentage charts and compare these things back and forth. Now, let me go to this watch list here, and we'll look at VIH. So if I'm active trading, right, I want to be trading something for me personally that has over 1.5 million shares traded per day. I know that seems like maybe a lot, but for me, 1.5 million is the minimum I'll take if I'm active day trading. Because if I'm day trading, I'm going to be trading 500 shares, 1,000 shares, 2,000 shares. I need that liquidity to be able to get in and out and not manipulate or move the market. With VIH that you see here, I'm not day trading this thing. This is something that I'm buying and I plan on holding it. I actually did buy some warrants today on VIH as well. So some of you guys might, you were talking about warrants the other day. I actually did buy some warrants on this. But yes, you're right. If you look at this you look at pretty much everything nowadays on a 1-minute time frame, it's going to have gaps and look all choppy and weird. This still isn't as bad as that chart that Brandon looked at though. It does have intraday gaps. But yeah, I would not recommend this as a day trading vehicle. This for me is something that is purely a longer term trade. Now, if you look at something like, Microsoft, okay, Mr. Softy, here's Microsoft. You don't really see intraday gaps. You might get them occasionally on something like Microsoft. Like there's a 1 cent gap right here. It looks like there's just a tiny little intraday gap. Those are okay. It's the big gaps you got to worry about. So anyway, I had to throw that in there for you, Rob. Normally, we are not looking for the illiquid stuff to be active trading. And you notice here the volume. You guys see I have average daily volume at the bottom, and you're looking at 30 million shares for Microsoft. And, one of my watch lists here, real quick, I'm going to see if I found anything, because this is part of my after day routine, is, guys, we got a whole list of hammers. You guys see there's a whole list over here on the side of hammer formation. So let's see if any of these come to fruition. BSX, Boston Scientific. It says that's a hammer formation. But see, Boston Scientific already 6 million shares average. I know that's safe to be an active day trader in it. Same thing here. Not bad. I actually like this one on eBay. It's not the best hammer formation, but you guys notice that price came right back into a rally-based rally from the 15th of March. So that's not a potentially bad one here. I'm going to run through a couple of others. Don't really like this one, even though volume is okay. Maxim Integrated Products. Another hammer formation, but it's really at a location that's worthy? No, right? Let's see. This one is interesting. This to me looks like a descending triangle. It's really just forming a base right here at this level, right around 89 and change, and it's making lower highs. So this activation looks like it wants to break down, even though that's a positive hammer formation here. So anyway, this watch list that I've built, almost everything in here is going to be over 1.5 million shares. I've removed everything else. I just don't need to see it if I'm an active trader. So anyway, what else we got? Patrick, do you see any big weakness coming in the equities like weekly? I'm going to actually do a deeper dive on this tomorrow because Alan sent in a question about that. So let me save that question, Patrick, for tomorrow. There is some interesting things going on with the market right now that does spell out some weakness. And you guys can help with the show tomorrow. If you have a rubber band, what you want everybody to do is grab a rubber band for tomorrow's show and just leave it on your keyboard because we're using that one for tomorrow's show. But you have to find yourself a rubber band somewhere and put that on your keyboard for tomorrow's show. I'll do an interactive lesson. Let's see what else. TraderMerlin, how did you lap them on each other? I couldn't. You mean overlapping multiple time prices on charts? I'll do two things on tomorrow's show. I'll dive deeper into that one, but I'll show you how to create it in TradeStation. But let's be honest, most people don't have TradeStation. So I'm going to show you real quick here because I want to keep this under an hour. You can go to stockcharts.com. And again, I have no affiliation. They should be paying me to promote them. Stockcharts.com. And I'll bring it up for you guys over here, make it full screen. If you go to stockcharts.com, there is right at the top, you guys see it says Snap Chart right at the top. If you click that and you go to perf chart, all right, there's a perf chart. It's like the sixth one down there. Now type in all the symbols that you want. So let's say I wanted to do the same thing I did. I want to look at QQQ. So I type in QQQ, comma, IWM, comma, SPY, comma, what do we got? What am I missing? Diamonds. Okay, so those are the four major market indexes. When you hit go, it now creates the same basic performance chart, right? So you can see here, I want to go look the last 200 day. This is a 200-day window, but if you want to shrink that down, you can do so as well. It's kind of cool because it always does it from the left side of the chart here and give you an idea of how that's performing in a specific window of time. So that's the easiest way to do it for everybody who does not have TradeStation. Koja, tomorrow, I will remind me on tomorrow's show, and I will walk you through the basics of how to do it. It's a much more complicated than TradeStation, to be honest, but TradeStation is a better technical analysis platform than StockCharts.com. All right, what do I have for us to round out here? Obviously, tomorrow is the weekend edition. Our Friday edition, I have no guest for Friday, which I like to do Friday shows solo. Given the way the cryptocurrencies took a big hit, I might be drinking Kool-Aid instead of beer tomorrow or whiskey, but that's been a wild ride there for the crypto markets, even though it's really, on the grand scheme of things, no big deal. It's just a pullback. Here's what we have cooking for, this is what I think was part of the reason you saw such nice moves today. Some of this economic data was very good. So they were expecting our GDP numbers, final GDP, to be 4.1%. Actually came out 4.3. That's obviously an improvement. You also can see here the unemployment claims. That was a pretty significant drop versus expectations. We dropped by 100,000 on unemployment claims, which is a pretty good thing as well from the perspective of the economy getting back on track, getting to full employment, and then the Fed potentially raising rates down the road, which, if it continues to drop, will be of concern that the Fed could potentially start raising rates sooner. Now, for tomorrow, there's a lot of stuff. The EU summit, that's going to be an all-day thing. Now, not as impactful as a Fed meeting by any means. However, there could be some moves depending on what European Union says. They still are not looking very good. They're having issues with their COVID rollout, vaccine rollout, so it seems to be rather problematic. U.S. for tomorrow has personal income and spending, goods trade balance, wholesale inventories, and then University of Michigan consumer sentiment. Most of those announcements happening pre-market. None of them are huge market movers, but they can still have an impact on the market. And you see most of those are coming out 1 hour before the markets open. And then the University of Michigan consumer sentiment and inflation expectations, that comes out 30 minutes after the market opens. Cool. All right, let's see. I'm going to freak tanks in. Yeah, well, Patrick, you can have your short guns ready to go, but let that market prove it because, I've been bearish on this market for quite some time. I've made more money going long, but my gut tells me this whole thing's going to tank. It's going to fall apart. It's going to be an awful situation. It just hasn't happened yet. So, when you jump the gun and force something to happen, you'll probably lose. So be careful. Make sure that you let that market come to you. As I told you, I have a Russell short and I have an S&P options short position right now, but I'm not too concerned. They're very small compared to what I have had in the past. All right, that will do it for me for today. Hopefully you guys enjoyed that with Brandon Wendell. If you want to learn more from Brandon, you can simply go to his Twitter page, which is going to be at TraderBdub. Of course, there's all kinds of education out there, and I like profiling different people to get you guys ideas of who you might resonate with. Next week, we got a pretty full slate of instructors, which I'll tell you about on tomorrow's show. So that does it for me. I'm going to be out of here under 1 hour. Again, thank you guys so much. I remember you, Sandpea? Sandpea? I don't know what that means. All right, cool. Anyway, I will. Oh, you mean my giant position on the S&P? Yes. That was a pretty big loser. Yeah, it should be a good reminder to you, right? I held that bias a little too strong. I got out when I said I was going to get out. Took a pretty big loss on it. It is what it is. All right, cool. That's going to be it for me, everybody. Hope you had a great day. Hope you enjoyed Brandon Wendell. If you did, give me a thumbs up out there. That said, I will see you all on tomorrow's show. Take care.